The Australian government just announced that they are going to introduce a new tax on unrealized capital gains. Yes, this does mean that you will be taxed on your assets before even selling it. However, there are conditions to this. That's why in this video, I'll go through what really happened. I'll also explain how it works. I'll then share my opinions on what we can expect to see next. And lastly, I'll uncover how you can get around this policy. Firstly, let's really go through what happened. Very recently, the Labour Party of the Australian government just proposed a new tax law called the Division 296 tax, which will tax 30% of all earnings generated in superannuations with balance over $3 million. You're probably thinking, this doesn't apply to me. Who the heck even has more than $3 million in their super fund? Well, 80,000 people in Australia actually do. And if you've been following me and actually done the tips that I talked about in my superannuation tips, you will be way over that threshold in your 60s. So yes, it might very well apply to you. This policy is to come into effect on 1 July this year and is budgeted to raise $2.3 billion in 2027 to 2028, over $40 billion over a decade. You might be asking, but haven't we been already taxed 15% on our super fund? Very good question. And that brings us to our second point. How does this actually work? For supers account in the accumulation phase or the pre-retirement phase, earnings are taxed at 15%. The proposal is for an extra 15% on top on earnings generated by the portion of the super assets that is over $3 million. And the saver has to pay this tax every single year. Here's an example. Let's say Dan, this normal guy, has $6 million in his super fund as of 30 June 2025. By the end of the next financial year, it grows to $7 million. From the ATO perspective, Dan has made $1 million in earnings. But under the new rule, only the portion of his balance over $3 million is taxed. In Dan's case, that's the $4 million of the total super balance. So 57% or 4 million of the 7 million of his super is now subjected to the additional 15% tax. If we apply that percentage to his $1 million gain, the taxable portion becomes $570,000. And at the new additional tax rate of 15%, Dan would owe $85,500 in additional tax. On the flip side, if Dan's balance stayed at $6 million, there would be no extra tax. And if it dropped to $5 million, the $1 million loss would be carried forward to offset any future gains. Now, let's really answer the question that's on our mind. What's happening next? But before that, if you guys are enjoying this video and would like more insights and tips about real estate, personal finance, property, crypto, or stocks, make sure you check out my newsletter in the description down below. Now let's go back to what can we really expect next from this policy. Looking forward into the future, one worrying thing is that the government will not be indexing according to inflation this $3 million threshold. This means even if inflation goes up in the next few years, this threshold will remain at $3 million. Given how inflation has been in the last few years, this is a terrible sign. Because you would never know. If inflation is going at the same rate, your super balance might get to $3 million extremely soon. And who knows as well, the government might go on and tax your capital gains outside your supers eventually too. So if this legislation actually passes through Senate, then super accumulation will not be a very tax-effective strategy anymore. So the main question is, how can you get around this? Now, a quick disclaimer, I am not a tax accountant and any information today is for entertainment purposes only. Please go see a professional tax accountant if you would like financial advice. Now, with supers being a less effective tax strategy now, one other option you have that you can explore is equalize super between spouses. Now, what is this? If you and your partner both have super, you can transfer any excess amount to the lower balance spouse super account using either contribution splitting or spouse contributions. What this does is that it helps you keep each account under $3 million. Another option is to start a family trust or company structure. So instead of piling more wealth into your super, you can set up a family trust or investment company to invest the excess funds where the company tax rate is 25 to 30%. The last option is to use the retirement phase cap efficiently. This means maximizing your transfer balance cap of $1.9 million from your super account into the tax-free pension phase to keep your super balance under $3 million. The thing is, everything I've told you is pretty much completely useless, because there are 10 other tips that if you don't follow, you will still be overpaying for your taxes. Watch this video next to solve them, and remember, subscribe to my channel and newsletter to see further insights about personal finance, real estate, stocks, and crypto.